Hey, we're back at it again. What's the topic of today? Trying to make you some money. And this right now is one of my favorite topics that I'm going to cover with you. And I'm glad you're here to listen to it. We're going to talk about tax planning. It's my favorite time of the year. I know most of you are going out shopping, thinking about the holidays, getting ready for that in the holiday spirit. But nothing puts me more in a holiday spirit than knowing how much money I'm going to keep at the end of a long year of working hard, long hours. Okay, so I have here the new tax rate plans, tables, everything I need to know to prepare awesome taxes and save you some money. And we're going to go over some of the key topics that you should know for this coming tax season and start getting ready now and start doing your planning so you can save the most amount of money that you can this year and put it back in your pocket. Okay, so we're going to talk about what tax tables are and how much taxes you're going to have to cover per class. So normally your taxes are divided into whether you're a single person, a married, you're married filing separately, or you're the head of household. So the one I'm going to focus on now is going to be the single. So this is your single tax bracket. And the good news is that this is very low right now. This is 22%. I've seen this as high as like 30%. But right now you can make up to $84,000. That's right, $84,000, and you're only going to pay 22%. That is a big deduction from before. It used to be, I think, like 34. So 22% is good. If, for example, you made $50,000, you're gonna make like 15. You have to pay like 15%. And if you make more than 84, it goes up to 34. So it's something around there. But I know for sure, single, $84,000 or less, 22%. Right? So that's great. Now your standard deduction also went up. I think it was like $9,000 last year. So this year is $12,200. And what that means, off the $84,000 that you made, they're going to deduct $12,000 right from the start. So you're going to end up paying taxes on about $60,000. That's how much you're going to pay. That's what your tax base is going to be. And so at the end of the day, if you do nothing else and you make $60,000, you made $84,000, your tax base is $60,000, you're going to end up paying about $20,000. Now that's a lot of money. To me, that's a lot. And it should be a lot for you guys also. If you're making $84,000, that means you're making about $7,000 a month, $8,000. And if you're paying $20,000 just in taxes, that means that 3 months of your work is going to the IRS. It's not staying in your pocket. So that's something you should start looking into, and something worthwhile for you to put a little bit of time and effort now while we're early, instead of waiting towards the beginning of the year, or maybe waiting until the last day, the beginning days of April, or the last day, which is going to be April 15th or 17th, to do your taxes, because then your tax man, someone like me, can't really prepare anything for you and advise you of what to do to go ahead and save you any money. So you want to get together with your tax man and figure out, hey, tax man, I'm going to make $84,000. What do you recommend that I do? And hopefully your tax preparer is all caught up and has read everything in here and has many years of experience to advise you in the correct ways to save you money, and you have enough time to do so now. So it could be worth $20,000 for you to check in now with your tax man and figure out what you're going to do. Okay? Next is your capital gains. This is exciting because I just realized that right now, if you have capital gains, it's $40,000. Of capital gains, you pay 0%. Now, a lot of people ask me, what is capital gains? I do a lot of taxes, and most people do not know. Capital gains is something that appreciates in value that you later sell. So for example, if I were to buy gold, if I bought gold jewelry, right, for $1,000, and then I sold it for $2,000, that would be a capital gain, because I really didn't do anything or change anything about the properties of my asset, but then I sold it for more. So that's capital gains. And I like this because it has to do a lot with businesses. And as you guys know, I sell businesses and I buy businesses. So this is it's a key factor because when somebody sells a business, they normally have capital gains because they worked at a business for a long period of time, and then they sold it, and they sold it for more than what they actually put into the business. So that would be a capital gain. And some people do not know how this works. Sometimes you work at a business for 10 years and you put a lot more into the business than what you actually sold it for. So that'll be the capital loss. So you're having a loss of what actually you put into the business, right? And that only happens when you actually sell it. Another thing that I like about capital gains is that, and I tell a lot of people that come in here, is like you have to become, if you see a business that you possibly would like to buy or that you know something about, why not become an investor in that business? If you become an investor, you can actually get capital gains. And that's exciting to me because you help out a business grow and you also get paid differently. So what I mean differently is that right now as you work in your own business or as you're employed, you're getting paid, you're in this area here, and you're getting, for every dollar that you make, you're gonna pay $2.20, 22%. But in capital gains, it means you actually didn't put work in the business, you didn't do anything in participating in the business itself, but you're $40,000, you're making you pay 0% in taxes. So what's the better way to earn money? Is it better to earn as an as a worker in your own business, or for somebody else, or to actually have capital gains? So when people see making a big change, it's because they're earning most of their money in capital gains and not paying any taxes. When you hear a lot of things in the news where they say, oh, so and so person does not pay their fair share in taxes, or doesn't pays 10% while everybody else pays 34%, that's because they're not using their tax man correctly and they're not taking the time to actually look into this. So one of the ways to become wealthy is to actually take use of this capital gains that you have here, right? That's going to help you because here I'm paying off of $84,000 with a tax base of $60,000. I'm going to pay $20,000. And here, off of $40,000, which is half of that, I should be paying $10,000, $15,000, something like that. But I'm paying zero. So I'm saving me a lot of money here. Right? So I want to move from this tax bracket into this tax bracket. That's what I want to do. And one of the ways to do that is become an investor into a business or into any kind of asset where you don't take active participation in it, and you can have dividend distributions, you can have royalties, you can have all these different types of income being generated from your capital gains, right? So this is key, and most people that I do taxes for have not planned for this part, only have this part, but they've never planned for this part. So if you need help trying to figure out how that works, then contact me and I'll put you in the right tax bracket. So potentially not this year, but next year and the following years after that, then we'll work together to make sure that your tax planning is in a form that it should be for you to save the most amount of money that you can. And lastly, your corporations. I do a lot of corporation taxes, and I help get you enrolled into corporations, and I love this part. This part used to be a lot better for people that used to make $50,000 or less in net profit. It used to be a 15% tax bracket, but in the recent years it's changed. It's gone to 21% tax bracket for everybody. Right? So say I was making $2 billion. Before I used to pay like 60%. Now I'm paying 21%. So the reasons why a lot of it in the news you're listening to, like, oh, Amazon didn't pay any taxes. Oh, eBay didn't pay any taxes. So-and-so didn't pay any taxes. Why? Because all their tax brackets will actually have come down. And the tax bracket for small companies has actually gone up. So before, somebody that used to have a corporation or has a corporation would make $50,000, it was 15%. Guess what? Now small companies are paying more in taxes, but it's still good. It's still kind of good. It's still 21%, right? And you can have this, and it's not much of a difference from this to that. You can actually make more money from your single. If you're filing single, then you're filing as a corporation. But I mean, that's how it happened now. Those are the changes, but it helps. It helps from here because if you have a corporation, then you could actually pay yourself here. You could hold distributions here, and you could have people invest in your business and offer this program to them and gain capital for you to grow the business. So it still has some benefits, not the same tax benefits that it has before, but if you know how to manage your corporation, then you can get a lot of extra fringe benefits for yourself from the corporation itself. So all these things do make an impact on how you're going to prepare your taxes this year. Hopefully you guys are thinking about it now and considering different ways. If you guys need more ideas on how to make your taxes work for you this year, give me a call now. Now is the time to start thinking about that. And while you're out in the holidays, I'll make sure to put a plan together for you guys to have a very, very happy holidays this year and a great beginning of the year. You have any questions, just let me know.